Assalamualaikum and hi everyone. Our topic today is payables, which is topic 7 under FAR210. So let's start. Let us look at the learning outcome. You should be able to define trade payable because trade payable is actually under payables as per FAR 132, which is on the presentation of financial instruments, and its recognition element as financial liabilities as per FAR 9. FAR 9 is on financial instruments. And the second learning outcome is to be able to explain the recognition element and measurement of trade payable as laid down by IFRS 9, to describe the derecognition criteria of trade payable. When can you derecognize a trade payable? Normally when the full payment to the supplier or to the accounts payable are being met. That's just some example. Emphasize on normal settlement of trade payables, present and disclose trade payables in the financial statement. So what are the objectives of providing information on payables? Payables, for example, trade payables, note payables, those are some example of payables. And normally trade payables, for example, it arises due to the purchase of goods on credit, or maybe when you were rendered some service by the supplier first before you pay pay them whatever the amount due. So those are going to give rise to trade payable, which is part of payable. So what are the objectives? This one is to attract more supplier or vendors that will give the company, the reporting entity, to be able to settle their credits. So information is important to show the information on trade payable, so that will assist the ability of the reporting entity that has credit with these payables, whether or not they can settle their credit or the amount outstanding within the credit period. Allow the suppliers, which is the payable, to ascertain the entities, the reporting entities' current credit status or the credit ability, the financial liquidity of the company. And also allow the reporting entity to have effective monitoring practice, so that they will ensure full payment will be made to the suppliers or vendors, so they can monitor the payment to the suppliers and vendors within the credit period granted. To control the entity, reporting entity, against increasing long overdue payment, so that you will not take up so much of credit purchase, because that will increase the potential of overdue payment. Next, the financial liability under MFRS 132, which is the MFRS on financial instruments, the presentation. You would see that it is saying that liability is a contractual obligation. So there will be a contract to deliver cash or another financial asset to another entity. So normally this is done, for example, after you have received the goods that were delivered by the supplier, or you receive, or the service are being completed. So you have the right to deliver, the obligation to deliver cash to another entity or another financial asset to another entity, or to exchange that financial asset or financial liability under a condition that are potentially unfavorable. Our focus will be on first part of the definition for FAR 210, and the examples that were given here, for example, written call options. B is the contract that will or may be settled in the entity's own equity instruments, but we're not going to focus so much on this. Our focus, as I say, will be on part A. The examples of financial liabilities. So why not we look at what are the examples? Notes payable, promissory notes, which is the written promise that we issue to our supplier to extend the credit payment, and that we may have purchased the goods and at the same time we issue the notes payable. Before this you have learned notes receivable, but this is the opposite of receivable, so that is payable. Receivable were actually a financial asset, so payable is a financial liability. Term loan payable, financial guarantee given, deposit that we receive, borrowing that we got from other entities, right? The debentures, bonds payable, debenture, remember these are non-current liabilities as well. Trade payable, which is current liability, which is the focus of this topic. Derivative financial liabilities, and redeemable preference shares, which is also non-current liabilities. And basically these are just some example of financial liabilities. Our focus will mostly be on trade payable. And what is the illustration? So I have one illustration here about promissory notes or notes payable in government bonds that give the holder the rights to receive. And receive what? Receive cash, and the issuer the contractual obligation to deliver the government bonds, not cash. So the promissory note is therefore a financial asset of the promissory note holder. To the holder is a financial asset, but it's a financial liability to the issuer, of let's say notes payable. So that is a financial liability to them. Let us look at these are some examples that are not financial liabilities. Deferred unearned revenue or contract liability. This is under MFRS 15 about the revenue that you receive, but revenue that you receive but you have not yet earned them, right? Then most warranty obligation, they are not financial liabilities. And because the obligation is to provide service rather than to deliver cash. Income and deferred taxes, they are not financial liabilities because those are the ones arising from statutory requirements. A warranty obligation, they are not a financial liability because, as I said, that was about the obligation attached alongside with the goods that were sold or the services that were rendered to the customer. And therefore the outflow of economic benefits is the delivery of goods and services, not the obligation to pay cash or another financial asset. So let's say warranty of 1 year. So that is a warranty obligation, not a financial liability. In terms of definition, payables, they are defined as the debts that are owned by reporting entity to the suppliers or vendors, which is the accounts payable, right, that arise from the purchase of goods or services that are received or rendered to the reporting entity. And reporting entity is our company. Liabilities that arise from the ordinary course of business. This is the one which are from day-to-day transaction, day-to-day business activities, where you buy goods for the purpose of resale. So when you buy goods from your supplier on credit, that give rise to payables. Normally, the repayment of payables, such as trade payable, are due in 30 days. And normally, that is also less than a year, which is a short-term liability. Sometimes may have been 90, may have been 60 as well, depending on the type of industry. What are trade payables? Trade payable arise from the purchase of goods and services received from supplier and others that provide services to the entity on credit basis. The service is given, but later only the payment will be settled according to the terms and payment. They are financial liabilities because why? They arise from the ordinary course of business. So it's not from occasional business, but it is from normal day-to-day business. So let's refer to page 281 of the textbook. These are some example of another types of payable, which is other payables. Accruals for expenses that incurred but were not yet paid. These are all also types of payable, but they are categorized as other payable, like utility expenses, accrued expenses for bonus and wages. These are financial liabilities that arise from ordinary course of business, and the operating liabilities need to be incurred as they are operating costs to run day-to-day business activities. So let's look at the recognition of financial liabilities. According to MFRS 9, when does the entity needs to recognize the financial liability? That is the question that we should ask. Financial liability, where I put FL, is recognized when the entity becomes a party to contractual provision. So here you can see it's about becoming a party to contractual provision. You can see here, right? And the and also of the financial instruments, which is the payable. When does the entity becomes the party to contractual provision? And also when the reporting entity has a contractual obligation to deliver cash or another financial asset to another entity. So we will illustrate this definition under MFRS 9 paragraph 3.1.1 in another slide later. Recognition criteria, according to the conceptual framework, it will be recognized if it meets the element of liability. Remember, the conceptual framework has the two criteria of relevant and faithful representation. So the transaction will satisfy the definition of liabilities if it meets the definition of what? Financial liability, and that has a high potential of future economic benefits flowing from the entity when the performance obligation is met. And the second one is faithful representation, where we can measure with certainty and that a measurement of how much is the financial liabilities are evidenced as per the so-called agreed contract. So let's look at our illustration to show the application of those definitions. Illustration 1, the entity that places the order on 27th of October. So on 27th of October, that was just an order that perhaps online normally they have the order received from their customer. But on that date, the reporting entity will not recognize a liability yet at the time the order was being met, because that was just an order. However, the commitment for the financial liability is being delayed until the order that were made by the company or for the services or for the goods have been shipped or been delivered and received by the reporting entity, received or rendered in terms of the service. So let's say the order was made on 27th of October, the goods were received by the reporting entity on 30th of October 2007. So the date that give rise to the recognition of financial liability, let's say trade payable, will be on 30th of October 2007, which is the date the services are being received, or the goods are being received, or the services are being rendered. Okay, let's look at the first illustration. 2nd of July 2009, Gagah Bhd placed an order from its supplier Derecognition Bhd for smart TV. So what you have here is a smart TV that were being ordered from your supplier Derecognition Bhd for 20,000. The smart TV and invoice were delivered on 4th of July. So on 4th of July, the delivery was being made by our supplier and it was received by us, we are Gagah Bhd, on 8th of July. So the smart TV was sold on credits. You are asked to explain when Gagah Bhd can recognize Derecognition Bhd as its payable or recognize it as a financial liability. It will be on 8th of July 2009. So when can the reporting entity recognize a financial liability? In our case here, we are the buyer, the customer, and we are the reporting entity as well. We placed the order again on 2nd of July. The goods were delivered, as I mentioned, on 4th, but were received by the company on 10th. So the date that we received the goods were the one that give rise to a financial liability to us, where we have a financial liability called trade payable. Trade payable here is Derecognition Bhd. The amount was 20,000, which arose on 10th of July. So therefore, we will recognize financial liability if it's relevant. Here that give rise to financial liability. This transaction on 10th of July give rise to financial liability trade payable. And the credit purchase transaction, because of the goods that were ordered, were delivered and were received, give rise to the contractual obligation on the day the goods were received by the by our entity, by the reporting entity. It gives rise to contractual obligation to us, the reporting entity, to deliver cash or another financial asset to another entities. Here there is only one entity, so I put here another entity. Sometimes you may have several suppliers. And because of that, it has the reporting entity has high potential of future economic benefits flowing out from the reporting entity. So future economic benefits that will flow out is the delivery of cash that will be made within the credit period. And this is only being met when the performance obligation is met. So the performance obligation is met by Derecognition Bhd when the goods were safely delivered by Derecognition Bhd to our company according to the terms and payment. So the performance obligation is met. So we have the rights, we have the obligation to deliver cash or another financial assets to that entity. In our case here is Derecognition Bhd. So it can also be faithfully represented. The amounts are payable are deemed certain. So how much is the amount? It is measured at 20,000. So these are the full answer to that. You have to recognize that on 8th of July, right? 8th of July, it should be 8th of July. So can you just make some correction? Because in the, yeah, it is 8th of July. So let me just do some correction here. Here should be 8. There was a typo. So this is 8th of July. Just make correction. Take note on that. It is 8th of July. And therefore, transaction on 8th of July is relevant because that gives rise to financial liability, as I have mentioned. So these are the wording that I used from my explanation just now. It has high potential of future economic benefits flowing out when the performance obligation was satisfied when on 8th of July. And that was faithfully represented where you have the amount to be measured at 20,000. These are the journal entries. If you were to recognize that, you will debit the purchase account 20,000 and credit accounts payable. Accounts payable here would be accounts payable Derecognition Bhd if you were to do the journal entry. Right. Now let's look at the measurement of financial liabilities. According to MFRS 9, entities shall recognize accounts payable or trade payable at the time the entity has legal obligation, when the legal obligation arises to pay for the goods and service that is acquired as per the contract or the invoice. The amount recognized should be at the transaction price, which is the price that you agreed upon in the invoice or according to whatever contract that was signed between the reporting entity and the supplier, which is the another entity that you call trade payable. In terms of initial measurement, the entity shall measure at the fair value, not only the fair value but plus the transaction costs that are directly attributable to the acquisition or issue of that financial liability. What is the fair value? Fair value is the amount for which liability is to be settled at. How much would you need to settle that liability at certain date, for example? This is the fair value. And that was the fair value of the payable on initial recognition will normally be the transaction price. Transaction price will include transaction costs such as fees and commission. Some fees and some commission. Next is another example here. Example 1, 2nd of July, Gagah made an order from the supplier for the books worth 20,000. The books and invoice were delivered by Derecognition on 8th of July. So here we are trying to show the journal entries. We have earlier done that and look at the date. It was 8th of July. Debit purchase, which is the credit purchase, credit accounts payable, Derecognition Bhd. Next example, example 2, AhFok, which purchase a car accessory. So these are the purchase being made for the car accessories. Right. From Unirest. Unirest is the other entity. AhFok is the reporting entity, and that was made on 12th of November. If you have no further information, you assume the goods were also being received on the same date. You are informed 30% was paid immediately by check, so that was by cash, and the remaining, which is 70%, will be paid in 3 months. Yeah, and the cost of transportation 380 was paid by AhFok. No record has been made by the by AhFok for this transaction. So you are asked to show the journal entry in the books of the reporting entity AhFok, to recognize the purchase of the car accessories, the purchase, and also to explain whether the transaction gave rise to financial liabilities. So the journal entry, debit purchase, and you will debit with 20,380, which is the fair value, 20,000 times 30% plus 380. That one would be for the cash purchase. This is for cash purchase. 30% was paid immediately. 380 is the transportation cost, and next one is the one on credit, which is the 70, the remaining amount 20,380 minus 6,380, so 14,000 is the 70% from 20,000. When should AhFok recognize? So AhFok should recognize on 12th of November. Why? Because that transaction is relevant, since UniRest has a high potential of future economic benefit flowing, AhFok will have a high potential of economic benefits to deliver cash to the other entity UniRest, since AhFok know that the performance obligation is being met by UniRest when the goods were received, assuming on 12th of November itself, and it was faithfully represented, where the amount that was deemed to be certain is measured at 14,000. It was due to the credit purchase transaction, not the total 2380, but the one that was 70% from 20,000, 14,000. Example 3, Gagah Bhd quoted price of an item is 5,000, trade discount is 8%, so you will have here some trade discount received by a reporting entity, Shopee Bhd. The purchases and payable account should be recorded at 4,600. Why 4,600? After deduction of the trade discount of 5,000, it should be at the 4,600, meaning that after the deduction of the trade discount. So journal entries should be in the books of Shopee, the reporting entity, debit purchase. How much? 4,006. Credits accounts payable Gagah. The name of the company is Gagah, right? Therefore, the company Gagah is the trade payable, which is a financial liability to Shopee. Example 4 is about Used Bhd. Quoted price of the item is 8,000. You have the trade discount of 5%, which is received by Used Bhd. From its vendor SST. The credit term is 610 net 60, so meaning that if you pay within 10 days, you get the 6% discount, but you must pay within 60 days. The purchase was made on 15th of August, year 10, from SST Bhd. So it's about use and the vendor SST. And 21st of August, year 10, you paid the amount due. You paid all the amount due. So you are informed paid the amount due. So without further detail, you assume you've paid the full amount due. So for the first transaction on 15th of August, that give rise to the purchase, credit purchase, debit purchase, and that should be deducted with the trade discount of 5% from 8,000. So we have 7,600. Credit accounts payable SST, which is our accounts payable SST in the books of Used Bhd. Use is the reporting entity. And 21st of August, you received the payment. So at first, amount due was 7,006, and that was paid within 10 days, because from 15th of August until 21st of August, this is less than 10 days. So if that is the case, you are still entitled to the cash discount of 6%, the cash discount. So you are not going to pay 7,006, but there will be a reduction of 456, 7,006 times 6%. So bank that will be credited is in our company is 7144. This is an outflow of economic benefit flowing from our entity in the form of cash. So there was no more accounts receivable. It gave rise, but later it was fully paid. So there was zero balance. So you can say that there has been derecognized. Trade discount and cash discount. Quoted price in our case here is 10,000. Trade discount 6% is received. The credit term is 510, net 60. Within 10 days, if you pay, you get 5% cash discount. And the purchase of goods was received by Lisa on 20th September from YY. So Lisa and YY. 22nd of September, Lisa returned the goods. So there was a return outwards, or the purchase return. 28th of September, Lisa paid all the amount due to YY. So fully settled the payment. So let's look at the journal entry. So there were different dates there. 20th September, take note on that. 20th September, 22nd September, and 28th September. So there are 3 dates that you may have to record in terms of the journal. So the first one is to record the purchase, deduct with the trade discount. So you will get 9,400. The second one is to record the purchase return of 2005. 22nd September, and the third one is to record the payment that were made to the supplier. So the payment that were made will be based on 6,900, which is 9,004 minus 2005. Since you are paying within the discount period of 10 days, which is in between this period, it was still less than 10 days, right? So you are entitled to the 5% cash discount based on 6,009, so 345. So the one that you credit to your bank account, which shows the outflow of the economic benefits of cash, 6,555. The accounts payable were fully paid in this example of Lisa Bhd. These are the example in the 3-column ledger. The answer, you can see at the end of the year, there are no more balance in the accounts payable. It shows that it has been fully paid. Or in a simple word, this is actually shows that it has been derecognized. That will be our next part that we will discuss. So let's look at the derecognition. So derecognition will be the case where entity will derecognize the financial liability when it is extinguished, and normally when the payment is being fully made in most circumstances, when the obligation specified in the contract is being discharged or cancelled, or that has been expired. So according to MFRS 9, paragraph 3.3.1. So discharge means fully paid. Cancel, maybe you are given discount that you don't have to pay at all. So let's say that was converted from a debt into just a donation by those accounts payable. You don't have to pay the debt. They consider it as a donation. That was also a derecognition because you don't have to pay anymore. It was cancelled, or maybe it has expired. So let us look at substantial, the derecognition of financial liability, where substantial different terms or modification of the terms in the existing financial liability or part of it shall be accounted for as extinguishment or cancellation of original or existing financial liability, and that can also give rise to a new recognition of another liability, financial liability. If there is a gain or loss that arise out of the derecognition, right, it will be recognized in the profit or loss as expense. For the gain, it is an other income. So let's look at question to illustrate this. Is example 6. You have KST Bhd purchase office equipment from TY. TY accept both cash and credit transaction. And on 15th of December, TY delivered office equipment to KST. So that is the day where they give rise to accounts payable TY to the point of view of KST, the reporting entity. And that is the date where the performance obligation is being met, amounting to 12,000 on credit before a trade discount. So this is before trade discount. So you have to go and incorporate the trade discount. KST paid 60% of the invoice amount on the same date. So 60% were paid cash, 40%, which is the balance, to be paid in January. So the accounts receivable is for the 40%. Accounts payable financial liability is for the 40%. For the 60%, there is no financial liability because it was a cash purchase. For the credit purchase that will be paid later in January year 10, that will give rise to financial liability, trade payable TY. You are asked to explain whether KST should derecognize TY from its books. So you will only derecognize if the payment were fully, or the item were fully settled, fully made in terms of the payment by 31st of December year 10. So you would notice that 40% is to be paid in January year 10. Our year end is 31st of December year 9. So year 9 was our reporting date, but you will expect payment in January. So let's see whether we can derecognize. Entities according to MFRS 9 shall derecognize when it is extinguished, normally when the obligation specified in the contract is discharged, cancelled, or expired. So in our case, we cannot derecognize TY from the books because KST has not yet fully paid or fully discharged its obligation. As the contractual obligation has not expired, it will only expire in somewhere January year 10, and there is still an amount due which is 12,000, where you get the 40%, right? 40% from 12,000, which is 4560 to TY Bhd. Thus, KST should continue to recognize TY as financial liability. So there is no derecognition. TY remains a trade payable, will be retained in the financial statement as trade payable. So that was the case of TY, right? That is still your trade payable. Only the 60% was paid in cash. The remaining was not yet paid. So let's look at Juara. Another example, Juara sells office equipment and accept both cash and credit transactions. 16th of November, Juara delivered the office equipment to KST. So it's about Juara and KST. Amounted to 25,000. So you have to see who is the reporting entity, and there was a trade discount given of 5%. KST paid 40% of the invoice amount and the balance to be paid in December. KST closes its account on 31st of December. On 15th, it's the 1st of December. On 15th of December, KST paid the outstanding amount. So by 31st of December is a reporting date, but on 15th of December, KST paid all the outstanding amount, meaning that whatever amount outstanding, which is 60%, 60%, why 60? 100% minus 40% will be paid on 15th of December. You are asked to show the journal entries on 16th of November, journal entries on 15th of December to recognize the transaction, and also whether should we derecognize the Juara from the books of KST. So the reporting entity is KST. The accounts receivable financial liability here is Juara Bhd, and the year end is December 31st December year 9. We have to do transaction for 16 November, and which is on the date the financial liability arise, and also when the date the payment were made, the outstanding amount. So let's see this. To recognize the trade payable is when the goods are received, the performance obligation is met, debit purchase, and you need to go and take note the trade discount that were given. So credit bank for the amount that were paid in cash purchase, and on 16th of November, when you credit trade payable, that give rise to financial liability, trade payable juara. And on later on 15th of December, you have to derecognize trade payable because you receive full payment, because the outstanding amount or the contractual obligation to deliver cash flow has expired when the outstanding amount were fully settled. The outstanding amount was this, and now we have fully settled the payment. So you can see that this is fully settled. So debit trade payable, we credit cash because we paid cash or we use bank, right? So that is done. And answer 7C is whether or not can we derecognize. The answer is yes, when the obligation is being discharged, cancelled, expires. Why? The KST should derecognize since it has fully paid the amount due, and therefore there is no more contractual obligation to deliver cash to Juara Berhad since it has been fully discharged or it has expired due to the full payment made on 15th of December. And you should not recognize, you must de-recognize the financial liability. So meaning to say that on this date 15th of December, there is no more trade payable Juara Berhad in the current liability of KST in the statement of financial position. You have another one, IB Collect, and this is the last example. Sdn Berhad had made a purchase of flour and other baking ingredients on account from Atan Sdn Berhad, which is the supplier, costing 50,000 on 5th of July, and 20% of the amount was paid immediately by IB Collect to Atan. And upon receiving the raw materials, IB Collect storekeeper find out that some of the baking ingredients were in low quality. That happens on 7th of July, and what they did was that the goods that were of low quality were returned back to Atan, the supplier, amounting to 2,000 on 9th of July. So they received the material 7th of July, though that gave rise to accounts payable Atan. But when they deliver back the goods that were in low quality, the return, that was a purchase return on 9th of July. IB Collect closes its book at 31st of August. No information was telling you about the payment being made by IB Collect to Atan. So show the journal entries to recognize the trade payable on 7th of July, to recognize the return of the baking ingredient of return outwards, and what is the amount owed by IB Collect. You have to answer that after the return of the baking ingredient. You have to show the 3-column ledger, and also to justify whether or not should IB Collect de-recognize Atan. You need to justify with reasons. So the first one is to recognize initial recognition of the trade payable on 7th of July, on the day they received the material, the baking ingredients and the flour. Debit purchase, credit purchase, there was nothing was informed about full payment, cash payment, so you just credit accounts payable 40,000. Okay, the Antas Sdn Berhad. When you return the baking ingredient, that was a return outwards, debits account payable 2,000, credit purchase return or return outwards 2,000. So with that, the amount outstanding will be 38,000, right? 38,000, and that would be how do you get 38,000? 40,000 minus 2,000. Before that, you would see that 20% of the amount was paid immediately by check on 5th of July. However, for your information, in the requirement here, you are not asked to show the transaction on 5th of July. You are just asked to show the recognition of trade payable on 7th of July. So the one on 5th of July for the 20% here, which is 10,000, that cash purchase is not required to be done here. So that's why you can see here, you straight away show the one on 7th of July for the cash credit purchase only. If you want to record for the cash purchase, that will be on 5th of July. Now 50,000 minus the cash purchase minus the credit minus the return outwards, you get 38,000. And for the transaction in the 3-column ledger, this is what happened. Accounts payable 40,000 and the purchase return 2,000, and you can see there was still some remaining balance of 38,000, and this 38,000 must be shown as your accounts payable, and this will be in the current liability, where in the statement of financial position. So IB Collect should not derecognize AhFok Bhd yet, because the contractual obligation to deliver cash flow to AhFok has not expired, since we have not yet fully discharged or fully paid the amount due. And here there is still an amount owing of 38,000 to AhFok, yeah, because only there has been no payment being made as at 31st of August 2000X3, the date where you go and prepare your soft P. And these are the sample presentation. So let's relate to IB Collect. So the current liabilities if you prepare for 31st of August should be 38,000 because of the amount not yet paid to IB Collect to accounts payable AhFok. These are the sample presentation in the real life or the actual financial statement, which is of the Sime Darby. Take note on the items that I have highlighted in red there. These are sample disclosure. Look at the current trade payable, which are showing how much belongs to the group and how much belongs to the company. With that, that's it. I'll see you when I will see you. That's the end of the topic. So after this, you will be doing more tutorial questions before you are ready for your quiz. Thank you for watching. I'll see you when I will see you. Assalamualaikum and have a pleasant day ahead. I am Madam Yusna Liza signing off. Assalamualaikum.